These 5 dividend stocks not only put cash in your pocket, but have an average upside of 152% to the top analyst price target. Hey Bowtie Nation, Joseph Hogue here, and we've been talking a lot about dividend stocks lately, so I wanted to cover cheap dividend stocks because it's actually the most dangerous strategy you can use. Hey, I get it. I'm as cheap as they come. I'm so cheap I only buy expired lottery tickets because it's half the price and all the dreams. So the idea of getting a cheap stock, one that could double in price along with that dividend cash flow, is so tempting, but there are traps here that cost investors thousands of dollars. So I'm going to highlight the 5 cheap dividend stocks that won't let you down, but also how to avoid the 3 biggest traps in dividend investing. I'll show you how to avoid the dividend stock that's cheap for a reason, like when Paramount looked like a steal only to crash another 30% when its dividend was cut. Or how to avoid the high-yield dividend traps, the ones like Zim Integrated that ended up killing their dividend altogether. Let's get started with our list of cheap stocks to buy with FMC Corporation, ticker FMC, with its 4% yield. But stick around and I'll show you how to avoid those 3 biggest traps in dividend stocks. Now, FMC had an unbelievably bad year, down 49% and making it the worst performing stock in the S&P 500 index last year. But this isn't just a blind bet on a turnaround. FMC is a leader in crop protection chemicals with sales over $4.5 billion in every continent. Folks, with arable land decreasing and world food demand increasing, the only way we meet world food production goals is with getting more out of where we grow. And that means ag chemical producers like FMC are a very good long-term picture. Why the stock makes the list this year, though, is for an almost comically predictable investment. This crop protection market goes through these cycles of boom and bust, growth and contraction every 5 to 7 years. And every cycle is the same. Profits and growth lead to oversupply and plunging margins, but that long-term demand growth remains and pulls the industry back into an uptrend. In fact, if you had invested at the trough of the previous correction back in 2015, you would have seen your shares triple to 2022 for a 23% annual return plus the dividend. Here, analysts believe the stock could make it back to as high as $76 in the next year alone. That is a 33% upside on top of the dividend yield. I'm not saying this is just a short-term trade where you benefit from that boom-bust cycle, though. I do believe FMC has the competitive advantage to take market share during this recent correction, turn itself around, and then grab a larger piece of that long-term crop protection market. That's going to make it a stable long-term investment as well and get that dividend cash flow to boot. And we're just getting started on our dividend list, but more important here, if you get one thing from this video, I want you to know how to avoid the 3 biggest traps in dividend investing. And trap number 1 is not knowing how to measure cheap in a stock. You see, folks, a lot of investors think of cheap in terms of a low stock price. Whenever I do a video like this, I get all kinds of comments about the stock prices, like I'm sure there are more than a few eye rolls when I said FMC is a cheap stock, around $60 a share. Nation, that's because stock price means nothing until you compare it against something else, like earnings or cash flow. Nobody is calling 23andMe Holdings a good stock after it lost 95% of its IPO price, even though it trades for just 52 cents each. It's like buying jewelry from the discount bin and then acting surprised when it turns your neck green. It's cheap, but not the kind of cheap we're looking for. What matters then is the valuation based on earnings, sales, or cash flow. It's by comparing the stock price to what you're getting in terms of earnings per share or revenue that you find that true measure of cheap. And these are easy to find on any investing site. Here on Yahoo Finance, you can go to the statistics tab and see these valuation measures like the trailing price to earnings, which is the stock price divided by the earnings per share that the company has reported over the last year. You'll also see price to sales, price to book, and enterprise valuations here as well. And then you want to use that valuation measure in 2 ways to find the best cheap stocks. First is you compare the current valuation with the stock's own past. Here we see that at 5 times on a PE ratio, shares of FMC trade way more cheaply than they have just in the past year, with a PE ratio as high as 21 times in 2022. And while that means investor sentiment is low for the stock right now, and investors just aren't willing to pay as much for every dollar in earnings, if that sentiment or the outlook picks up for this stock, then it could shoot higher. Even a valuation of 10 times on a price-to-earnings basis would nearly double the stock price. Next, though, and just as importantly, you also want to compare a stock's valuation measures against that of its peers in the industry. And here we see shares of competitor Nutrien are trading for more than 20 times on a PE valuation, well above where they have been in the past. And there's a lot to read into this. One is that FMC does appear to be a cheap stock because it has that much lower PE ratio compared to its peers, but also that there might not be something wrong with the industry right now. If all the stocks in the group were trading at that lower PE than their own histories, I'd say this was an industry-wide problem, but The fact that competitors are trading richly on their own valuations makes me go back and make sure that there aren't some company-specific problems at FMC before I want to invest. I know it's a lot more than just listing out a bunch of stocks and saying, go buy these, but I want you to be a better investor, and these are the tools you need to find your own stocks. I've been watching regional banks lately, and one of my favorites, Regions Financial, ticker RF, pays a 4.9% dividend. Now, higher interest rates have destroyed valuations and cash flows for commercial real estate, and because smaller regional banks hold 80% of the $3 trillion in commercial real estate loans, the fear is that massive loan defaults are going to kill these banks. The broader S&P regional banking ETF, the KRE, plunged 39% in last year's bank crisis and has recently fallen another 13% when fears were reignited in January. But with Regions, it has just 14% of its total loans in commercial real estate, about $14 billion of the $98 billion portfolio, which is much lower than the 60 or the 70% we see at the troubled banks. And that means the sell-off could be an opportunity to pick up shares at a discount. Shares trade for a price of 1.14 times the bank's book value. Now remember, because banks carry their loans and deposits on the balance sheet and then adjust them for market value, that book value shows us a picture of the company value, and we use that price to book value instead of the PE ratios when we're looking at bank stocks. You can see that current price to book value is well under the 1.49 times book the shares traded at in 2022 before the crisis in regional banks. Of the 17 analysts covering this stock, the high target of $27 a share is 46% above the current price. Even a move back to that 1.49 times book value before the crisis would be a 31% return from here. We'll get right back to our list of cheap dividend stocks, but even the best stocks are going to be pointless if you don't start with an investing plan right for you. It's why I created a quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing, and that is customized to your needs. I'm going to leave a link to that below in the description. It's totally free, just something I wanted to put together for all you out there in the community, so click through and get your step-by-step guide. I've seen too many investors, folks, miss out on the opportunity to make their money work for them, and it's because they didn't have a plan that fit their needs. So look for that link and get your free customized plan. Mercedes-Benz, ticker MBGAF, is one we haven't covered before on the channel, but it is definitely worth a look on its 7% dividend and new profitability. Like a lot of the other legacy automakers, Mercedes has recently walked back its goal on electric vehicles. Not having to target that prior goal of 50% EV by 2025 is going to mean lower spending on this and higher profits for investors. Mercedes is already strongly cash flow positive, generating over $10 billion in free cash flow with nearly $15 billion in balance sheet cash reserves. That's enough to grow the dividend and buy back the stock. Shares here trade for just 5.17 times on that price to earnings basis, and not much below where it has traded in the past, but well below its competitors. Shares of GM trade for 5.5 times PE, and Ford trades for more than 11 times its earnings. So there is definitely room for Mercedes to improve that investor sentiment and boost the valuation metric from here. Analysts do have a wider target range for Mercedes, so a little more uncertainty on the price here, but that $135 high target by Tim Rakosa of Deutsche Bank is a solid 68% upside. Even a move back to that 5.5 times on that comparable PE ratio with GM would be a 6% return on top of the 7% dividend. Now, these stocks of the legacy car makers aren't going to make you rich like Tesla, but it is a long-term cash flow that you can count on. Trap number 2 for dividend investors, and this one catches everyone at some point, not seeing that a stock is cheap for a reason. And this one is so tough because almost all stocks that have fallen or are cheap on a valuation basis are that way for a reason. If everything was rainbows and unicorns, if the industry was booming, and if the company was doing everything right, the stock price would be going up instead of down. The problem here is investors just look at those valuation measures, see a low PE ratio, and think the stock has to get back up eventually. It's called trying to catch a falling knife because you're betting that the stock price stops falling, but it can be extremely dangerous to your portfolio. In avoiding this, it's about doing that deep level of research we talk about here on the channel. There are no easy answers here, folks. You have to dig into the company's fundamentals, the recent news, and the analysis to understand both the bull and the bear case for the stock, then decide if the company can turn itself around. For this, usually the first place I go is the debt-to-equity ratio and compare that to its peers as well as the company's own history. Nation, nothing is going to kill a company faster than too much debt because It just saps that financial flexibility the company needs to orchestrate a turnaround. Devon Energy, ticker DVN, has been a long-term favorite here on the channel for its 5.3% yield and high dividend growth. Devon is a leading oil producer in 3 states, North Dakota, Texas, and Delaware. It's used acquisitions to build on those core assets in the Permian Basin production area and has deep inventory of reserves. The company saw cash flow quadruple with its WPX merger, along with higher oil prices over the last few years. That allowed it to boost the dividend 17-fold in just 2 years to September 2022. Now you can see here that it's brought the payment back down to protect cash flow, but this is still a cash flow machine. Now, while Devon isn't necessarily cheap against its own valuation history, trading at 7.7 times on that price to earnings basis, it is very cheap compared to peers like Diamondback Energy, trading at 10 times PE, and a 41% discount to the 13 times PE ratio investors are paying for larger Chevron Corporation right now. And it's in Devon that we see one of the highest potential upsides to the average price target, as well as that high target of $75 a share, a 68% upside from here. Before that next cheap stock, one with as much as 547% upside. Trap number 3 is chasing super high yield stocks. This is where you find a stock with a juicy high dividend yield, but fail to see that yield is only that high because of a massive drop in the shares and a critical problem with the business. For example, investors were drawn to the 7% plus dividend on the shares of VF Corporation, a stock that normally paid less than 3% yield. That was all before the company pulled the rug out from under them with 2 dividend cuts in less than a year. And this one is so painful, like the financial equivalent of diving in just before they drain the pool. And avoiding this problem starts with just looking at the stock price. Has the stock fallen so much that the dividend yield has jumped only because the company is still paying that same amount it did last year? If so, does the company have that cash flow it needs to keep paying that same dividend even if the business fundamentals have weakened? For this, you need to go to a company's statement of cash flows. For example, we see here that Verizon has seen its operational cash flow, that core cash flow from the business, fall progressively over the last 3 years and is now down more than $4 billion from where it was in 2020. We can also see that while the cash the company needed to invest in the business fell last year, that investing cash flow, it is still about the same as it was a few years ago. Telecom is a very capital-intensive business, so those investing cash flows is going to mean spending tens of billions of dollars every year. So when we take the company's operating cash flow minus what it spends to reinvest in the business, we start to see a problem here. $37 billion in operating cash flow last year, minus the $23 billion to invest in the company, only left $14 billion, which, after the $3.6 billion in net payments on debt and other financing, only left about $10.4 billion in cash, not enough to pay the $11 billion in dividends. The fact is, folks, Verizon is just not generating enough cash from the business to keep the company going, pay down debt, and keep up that dividend that investors have come to expect. Cash is king for your stock picks and can mean even those with falling stock prices can keep up their dividend. Start running out of cash though, and that dividend is going to be the first thing to go. Now, speaking of the cash flow troubles in telecom, it might seem weird to put AT&T, ticker T, on the list, but there could be some short-term upside in this stock. I have been negative on the whole telecom group for a while, but cash flow is better at AT&T, and the rebound potential in these shares, along with that 6.5% dividend, makes this one worth the risk. Operational cash flow jumped by $6 billion last year, and the company is moderating its investment spending, which helped to boost that free cash flow number by more than $8 billion. AT&T also has a much lower debt burden than Verizon, all of which means the dividend is safer with T. Of course, that didn't help investors in 2022 when the dividend was cut, but their pain is your gain because it's a more sustainable payout right now and a good yield. And it's that combination of a rebounding cash flow, lower debt, and a sustainable dividend that could make this a strong short-term play. I wouldn't bet on the long-term health of the telecom companies, but an upside target to $109 per share could mean a triple-digit return for brave investors. Even the average price target here, though, is 58% higher. Get your customized step-by-step investing plan and make sure your stocks fit your goals with the link in the description, or click on the video to the right to see the dividend stocks in my portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.